Good morning, everyone. This is Katie Novotny calling in from Premier Marketing. First and foremost, as always, I want to welcome you and thank you for joining us this morning. We are seeing so many movements on the products in which we have in our department, whether it be CI, DI, short-term care, but especially traditional long-term care products right now. A lot of questions coming in and out, a lot of illustration requests, and who are the players? So what we thought was we were going to get a hold of our top players and see if they just couldn't give us some ideas of where they'll be positioned, what they've seen, and where we think they're going to go. So that being said, we have Lawrence that is going to walk us through the National Guardian Life long-term care product this morning. And throughout the presentation, please feel free, type in questions, comments, and we will be addressing things as we move forward. So with that being said, Lawrence, you ready?
I'm good if you are, Katie.
All righty.
Good morning, or plausibly afternoon. No, East Coast is still 11:30. Good morning, everyone. Thanks for taking some time learning a little bit more about NGL as a company, as a product called Essential LTC. And, you know, to keep with the theme of the title of the session today, which was, you know, where have we been? Where do we plan to go? What's 2021 going to look like? What's on the docket? I do want to speak to that as we go through here. And I am going to speak towards the sweet spots of the product, how we compare, what some of the key features are, but trying to thematically tie that back as we go through. So to begin, where have we been? Well, as of 2016, we have been in the long-term care market. Prior to that, we have not been in the long-term care market, so we hadn't really been anywhere. And we were able to jump into long-term care in 2016 with the Essential LTC product. And the reason I talk about that, and I want to speak to where we have been and why I said, well, we haven't been here prior to 2016, is because we came into this when this industry had learned a whole lot about long-term care insurance. Right? Because let's look at, when did long-term care start getting real popular? Roughly the mid-'80s, something along those lines. So by 2016, we have 30 years worth of experience we can look back to. And we have a tremendous amount of claims data now, whereas even 10 or 15 years ago, we had nowhere close to as much. So when we partnered with our TPA, who's been doing this for over 3 decades, we're able to come in as a solid, excellent rated, solid assets company and create a product called Essential LTC that's not only competitively priced with some really interesting, rich, and flexible plan design features, but now we feel like we have a pretty good idea of how to price this thing. This industry now has a pretty good idea of how to underwrite traditional long-term care. Because with pricing and underwriting assumptions that maybe didn't go as well as planned, say 10, 15 years ago, now I think we've got a pretty good grip on that. So when I speak to, you know, we hadn't been here prior to 2016, I see that as a huge positive because we don't have any baggage from some legacy business that was mispriced or poorly underwritten. We're not making decisions worried about some mistakes we made a decade or two ago. We're coming into this fresh with a ton of information and experience from this industry over the last 3 decades, and we can make decisions looking towards the future. Okay, so we're hopeful that that will create a product that will have much more of a clear path forward in terms of what the rates are going to look like, potential rate increases, things like that. And some folks will say, well, hey, some of these features, and we'll talk about them shortly, we haven't seen these in a while. How can you bring this back? And it's because of what we just talked about. We don't have any of that legacy business where we've made mistakes. And now there's so much more information. We can price some of these features and bring them back, i.e. a single premium payment option. We'll talk about that a little more in a minute. So why do we need NGL in 2021? Why should you consider NGL? One, this is another where we have been. We're available just about everywhere now. As the product was launched, it goes through that couple of years cycle where we're getting to be available just about everywhere. California, of course, took longer than that, but we were able to add California last year. New York and Montana are the only two gray states where we're not available. You see them on the screen. We plan to be in both. We're working on the filing for New York, hopefully going to get that in later this year. As you know, that will be a couple of years process, and we're also working on Montana and what the interesting filing requirements are there with regards to only having unisex rates. So we do plan to be everywhere in the country in the not too distant future. And to speak more towards product and some of those unique features we were talking about, and this is where we are now. And this is why I think you need to think about NGL in 2021. And I understand long-term care planning is never going to be a one-size-fits-all. Essential LTC isn't going to be what works for 100% of your prospects. But I think with the features you see in the black font on your screen, we have some pretty interesting things that are going to work for a whole lot of the people you talk to. I'll begin with the first bullet there, and I want to talk about the tremendous opportunity I think we have available for couples. So for couples, we issue a joint policy, and our shared benefits are separate in a third pool of money. So to kind of illustrate what this is going to look like, you have Mr. and Mrs. Insured. You issue them with NGL one joint policy with a joint premium and a joint waiver. Okay. If you sell the shared benefit amount rider, notice I didn't say shared care, I said shared benefit amount rider, because it truly is a separate third shared benefit amount. So how does this all logistically work? So let's say Mr. Insured goes on claim. He uses all of his pool. He's out of benefits. What can he do? Well, that blue arrow on the screen is kind of like his bridge into that shared benefit amount. He still needs care. He could use some of or all of the shared benefit. In my example, let's say he uses about 80% and passes away. Well, Mrs. Insured still has all of her benefits left. So let's say she uses all of her benefits. She can then also walk across her little bridge and use what's left in the shared benefit amount. Okay, so they will never touch each other's pools in the joint policy. You run out of your own, you can go into the shared. So I take some time and say, hey, here's where we are now and why this is such an interesting feature and why I think you need to bring this up. And it's because of this. Just looking at a 2-pool versus a 3-pool kind of a model, look at the bubbles on the bottom of the screen. That's the difference in day one total benefits on a 2-pool versus a 3-pool model. Yes, the premium difference is tremendous on the top of the screen. We're very competitively priced the way the market has fluxed right now. So that is another reason why I think you should strongly consider looking at NGL for many of your cases. But the bottom of the screen is the big difference for me. I mean, that's day one benefits. Fast forward, say 30 years, when this 55-year-old couple's 85. It's going to be about a $500,000 difference in potential benefits, which is tremendous. And by the way, if you can't read the fine print on the very bottom, this is pretty straight down the middle, plain Jane long-term care. You know, there's some rumor I've heard here and there that NGL product is confusing. We have a lot of really cool stuff, but we can really simplify it. This is plain Jane long-term care. This is $200 a day, 3 years, 3% compound, shared. Not much very confusing about that. Okay. Now we do have some, real unique bells and whistles. For example, you can sell lifetime benefits on a traditional long-term care product again. Personally, and this is probably my personal bias, I'm not the biggest lifetime benefits person, not only because statistically most people won't need it, but let's go back to what you saw on the previous screen. Okay, let's say you sold a 5-year benefit period and you sold shared. That is 3 5-year pools of money. How many couples are going to need 15 years worth of care? Statistically, not that many. And that's a whole lot of care in my book, 15 years for the couple. Now, one person can't use all 15, of course, but one could potentially use up to 10. That's a whole lot of care. Is it lifetime? No. But it's a lot more than most people are going to need, and it's a lot cheaper than lifetime. So if you're selling joints with the shared, I don't think you should play with lifetime all that much. 5 or 6 year with a shared third 5 or 6 year pool is a phenomenal plan for some couples. But for those folks who want to pay for that ultimate peace of mind, that's why lifetime's here. Some other pretty unique features. Premium payment. Why do you need NGLs to look at in 2021? You can sell a guaranteed premium traditional long-term care policy if you sell the single premium payment option. It is non-cancelable, fully paid up on day one, will never be subject to a rate increase. On the 10-year premium payment option, could you have an increase during the first 10 years? You could, less likely, but you could. And once you're paid up, in year 10, you will never be subject to a rate increase. You're fully paid up. We will never ask for another penny. So for folks who come to you and say, hey, I've heard about these rate increases in the news and I don't know about long-term care, you've got two really interesting tools here to help you mitigate that concern with the single or 10-year premium payment options. And we've got some interesting riders here that can either create a surrender value and or a benefit at death if care is never needed via a return of premium. So I talk about some of these features and it sounds a whole lot like an asset-based product, right? I talk about lifetime benefits, single pay, guaranteed premiums, benefits at death if you never need care. Sounds a lot like an asset-based product, but it's all on this traditional chassis called Essential LTC that can provide that same value proposition of whether you need care, there could be a benefit. If you die and you don't, there could be a benefit. And even if you decide you might want to cancel the policy, there could potentially be a benefit. So Mr. and Mrs. Client, I can create that same value proposition here. And whether you live, you die, or you cancel, this policy could provide you a benefit. So why I take some time on this call and talk about these features is because I think it will tremendously increase the efficiency during your sales conversations. And the reason for that is because I feel many people out there begin the conversation and provide a traditional style solution, right? Pure long-term care benefits. And you can take this Essential LTC arrow out of your quiver and do that. Then if the client can't get past the what if I never need care conundrum, you don't have to put the arrow back in your quiver, take out another one, explain that company's history, their financials, and how life product chassis work and all that stuff. You can just keep this on the screen and check a box. And then you have a benefit at death if you don't need care. Then you can check another box if they say, oh, I absolutely want an out. I want a surrender value. I want some liquidity to this thing. Again, I get it's not one size fits all, but this product can fit many, many different situations, whether they be traditional conversations, whether they be hybrid-like conversations. Okay. How we do it is via these things called return of premium riders. The first being something called a limited return of premium. And for those of you who've been doing this for a little while, it's the same thing it always used to be. Like when every product had this on its chassis, 10, 15 years ago. But now I talk about it differently. Because what else happened in the last 10 or 15 years? Hybrid products got really popular, right? Because back 10 or 15 years ago, we said, oh, return of premium, don't sell it, it's expensive. But now, the way this product's priced, it puts you right into the category, the pricing bracket of many of the hybrid products. In fact, in some cases, it looks even better. So how this works is we look at premiums paid, we look at any benefits received, right, claims, and if there's anything left, it goes to the beneficiary. Isn't that exactly how a hybrid works? Just that first stack of money is not called a premium, it's called a death benefit. That's reduced every dollar for long-term care claims, and if there's anything left, it goes to the beneficiary. And of course, if claims are much larger than premiums paid, the beneficiary won't get anything. So I think this is the most commonly used return of premium rider and will fit into a lot of those hybrid sales types of scenarios. And again, you can get there by offering a traditional plan and then just checking a box for a different rider to provide a benefit at death if they can't get past that what if I never need care type of a conundrum. We also have a full return of premium, much more expensive. I don't think you'll use it as frequently, but no hybrid can do this. And what it says is, hey, we'll look at premiums paid, and you know what? Regardless of any claims, every penny is going to go to the beneficiary when you die. as long as the policy is still active. Pretty interesting story. Again, more expensive, but a pretty interesting story. Now, I also have two more return of premium riders, and they work just like these, but they add a surrender value, which, as you can see on the screen, grades up to about 80% of premiums paid, and it will stay there for the rest of the life of the policy once you hit that 4th anniversary. So, again, not one size fits all, but why should this arrow be in your quiver? How is this going to compare? Well, one of the larger hybrid products out there is something I'm going to show you right now. With a 55-year-old couple, let's say they have $150,000 available to fund their plan, and let's look at a potential, what do the benefits look like in 30 years? So here's one of the larger hybrid products. I took roughly the same amount of premium, that $150,000, and this particular carrier loves their 6-year benefit period. And I'm going to put it up against our 5-year. The reason I'm using less is because we have that shared third pool. So let's look at the difference in potential benefits at age 85 for this couple. It's roughly $1 million. So we can be very competitive against some of the hybrid products out there. What if they die and never need care? You have very comparable benefits. What if they change their mind and they want to surrender? You have very comparable benefits. Okay. Now, some of the more astute folks will look at this and say, Lawrence, you're not showing me your daily next to their monthly. Something must be off. Well, there's already enough numbers on the screen, and I didn't want to confuse you. But if you really want to see it, I had to start adding it to this because I got that question every time. So actually, we're better in both scenarios. So we can be really competitive in some of these things. So that's one of the reasons where we are now, where we plan to go. We plan to really try and earn some of this hybrid business because we can provide a tremendous value comparatively in a lot of the situations. Another one to mention real quick, there's another hybrid carrier out there that loves their lifetime benefits. And their product is sold in a way where the daily benefit on the base part of their policy, or monthly benefit, I divided by 30 to give you a daily equivalent, will not increase. It doesn't have inflation. Can you add it? Yes, but it generally doesn't keep them as price competitive. And I mentioned earlier, I'm not the biggest lifetime guy, but I'll play, devil's advocate here, and I'll show you our lifetime. But first, I'm going to show you how to just check that box and keep your sales conversations flexible. Say this client came in with the quote on the right. Then I'd show them this on the left and say, look, I've got this traditional product and I can give you lifetime benefits, but I can give you pure long-term care, which is why you came here, to plan for long-term care. So I can use long-term care insurance to do that and give you more benefits for your premium dollar. Which side of this chart's more appealing? Would you rather have 461 as your daily benefit from day one after your elimination period? Or would you rather have this scenario on the right where you're going to have more out-of-pocket expenses during those first 33 months? Then I just let them think and talk. And if they get to that point, well, what if I die and never need care? You have a 0 down there. Well, Mr. and Mrs. Client, I can keep your premium roughly the same and create that benefit at death if you never need care, but your daily benefit's going to go down to about $300 a day. Now, which one's more appealing? The left side of this chart, where that's your day one benefit of claim after the elimination period, or the right side, where you're going to have out-of-pocket expenses for the first 3 years. Well, you have 0 for the surrender value. What if I want that? Okay, I'll keep the premium roughly the same, and the daily benefit's going to be about $270 a day. Then you can have comparable die and quit benefits. So pretty interesting pieces of flexibility here. And this was using the lifetime, which again, I said, for couples especially, I'm not the biggest fan. So what if I used a 5-year shared, 15 years worth of care for the couple? Well, it would look like this. Is it lifetime? No. But is it 3 5-year pools of money? Yeah, sure is. And your day one daily benefit after the elimination period at age 85 would be $388 a day, compared to the right side where you're going to have out-of-pocket expenses at claim time. So pretty interesting, flexible ways you can have the conversation using this product. To tie back to the theme of the webinar again, where we plan to go. I think in 2021, especially given market conditions with a carrier exiting who did a ton of worksite long-term care, I think we're going to see a lot more smaller executive carve-outs coming to NGL in 2021. So we do have a program for the worksite. I want you to be aware of it. It is a unisex employer group rate class available to all our issue ages. Very competitive for couples. Our group approval is simple because we're going to underwrite the individual. Okay. Why? Well, we're able to do a quick group approval. We're not going to give you census analysis paralysis. We generally approve your group same or next business day. And we're able to keep our minimums low by underwriting the individual. Some states, we just need 2 issued employees. Other states, we need 5. But we'll look at just about any business that has at least 5 employees. So this is a great program for small groups, closely held businesses, you know, maybe the business owner and their key partners, or for executive carve-outs. Do we fit the mega, 20,000 person groups? Personally, that's not why this program was designed. And personally, I don't think it's a great fit. You'd be square hole round pegging it. Have some people done it? Absolutely. You can do it. But it is individual underwriting. So I don't think we fit that mold very well. We're more for the closely held small carve-outs. And as it says, almost any business with 5 employees. We truly mean that. As long as you don't send me a group approval that's for a company called like Bomb Testers LLC or something similar, we're likely approving your group same or next business day. And not to mention, especially for the executives who are considering hybrid plans, this is a long-term care chassis. Even with the return of premium for C Corps, you can deduct the whole thing because we're not on a life insurance chassis. Okay, so don't forget the tax. And another interesting piece with this product is the fact that because we have a single premium, it opens us up to the opportunity for a lot of 1035 exchange business. And I feel like we will be continuing to capture more of that from the advisor side of the market in 2021. So I do see some potential there. And as for the where do we plan to go side of the title here, NGL is very, very committed to this marketplace. I think we've discussed some really interesting product features, gone through a couple of pretty interesting sales ideas with how to position it as asset-based, bringing up 1035, which I can go into in more depth and how you have that conversation if folks would like, just type that in, and opportunities for the work site. So we've got a great product with great pricing, and a big piece of what we did in 2020 was listening to you and listening to, hey, you guys have a great product, but I would love to see this feature or that feature, or, hey, this little piece of how your product works, it'd be great if you could enhance it and make it do this. So for the better part of last year, and I mean way back to January of last year, we had been compiling that feedback and working on enhancing the product in a number of ways, as well as adding some additional riders for things folks say that they'd really like to see. So where we plan to go is to do that for you and give you what you say has been very important to you to offer to your clients. So I think you'll be seeing some great news with regards to enhancing the product. And by that, I do not mean we're just changing the pricing. We are not just changing the pricing. It is truly going to be a product enhancement. The product is going to do more and have more available. And I'm hopeful that many of you will see that as a positive change when that happens, because we do plan to announce that at some point in the first half of this year. So be excited. It is not just changing the new business rates. Something else that's new and exciting that I want you to play with. This is our new quick quote calculator. It is not a full-blown illustration. It's a quick quote, and it looks just like this. It's open access. You can literally run this plan in about 15 seconds. So that easy. There's no login required. And it provides this great imagery on the right side that not only shows you the 3 pools and what the premium is, but also tells you kind of the value piece of the conversation. Well, hey, a policy issue, here's what you paid versus the benefits available. And here's what that looks like at age 85, right? And on the screen example, hey, you would have paid in about $81,000 in premium, but you got roughly $1 million in long-term care benefits. Pretty tremendous thing to have there right on a quick quote, you know? So I'm hopeful that many of you can play with this. The URL is on the bottom of your screen, and I'm sure Katie will blast it out after the call as well. And with that, I think I've been talking long enough. Katie, any questions jump in or anything I can address that maybe I might have skated over?
No, we actually have a lot of questions just coming in the last couple of minutes. So first
Beautiful.
one is going to be, can the employer group be sold year-round? Meaning, is there an enrollment period? Because
unless you want to set one and kind of just market it to them that way, some folks like having that end date to make people have action. We do not hold you to any type of enrollment period. And that, again, that's the beauty of not having that kind of an underwriting concession. We're going to fully underwrite the individual. So yes, you can send in apps all year long. There is no set enrollment period.
And with the employer groups, can they be payroll deducted from the employee?
Absolutely. We do have a list bill available. How the group handles payroll deduction is entirely up to them. You know, the way I put it to many people is, look, we don't care where the money comes from. That's entirely up to the group. We will just send the group the list bill and expect the payment in return. Keep it easy.
Perfect. Next one is can you expand a little bit on the 1035 exchange?
Yeah, absolutely. Bear with me just 1 minute, and I have to back up a few slides, so I will pause the screen. Here we are. All righty. So with the 1035, you know, and there's a lot of folks out there who've been doing this for a while who didn't quite know that this can happen. And part of that is because of the Pension Protection Act, which didn't truly go into effect until 2010. And I feel like that's why most people don't know much about this, because by 2010, I think there was one carrier that still had a single premium, which is what makes sense for most 1035 transactions. And that carrier at the time wasn't accepting 1035s, and then they shortly thereafter discontinued their single premium. So now that we have that available, it makes a lot more sense. So how it works is you can take the surrender value of a non-qualified annuity or a life insurance policy, and you could potentially take all of it, even the stuff they never paid tax on. So the principal and the gains, and that pays for your long-term care insurance on a tax-free basis. And the benefits that come out the other end are tax-free long-term care. So with this tool, you can take what is potentially a taxable asset and turn it into tax-free long-term care benefits. So administrative type stuff to look out for. I can't play with qualified money using Section 1035. It has to be non-qualified, okay? Something you're going to run into with couples, if you have, say, the husband in a couple has a life insurance policy, I cannot take that and put it into joint long-term care because the money's coming out of a single insured policy. So to go into joint long-term care, it's got to come out of a joint annuity or a joint life policy, say like a survivor life policy. If you do run into that, there's some tips we can provide you. In fact, I've been running into a lot of those life policies lately, but they're underperforming ULs. So I say to the person, well, hey, look at the cost basis. Because if it's at cost basis or below it, they can just take the cash out of the policy in regular money and they won't be taxed on it because it's at cost. Or if it's slightly above cost basis, the tax hit would be nominal because there's a lot of underperforming ULs out there right now. If it's an annuity, a lot of times the folks can just call up the annuity carrier and add the spouse as a joint annuitant. We've seen that happen a lot of times, and then we can initiate the exchange. So just some things to look out for there. And keep in mind, if you're doing it on a single premium basis, you have a guaranteed premium long-term care policy that will never have an increase. So that's kind of the logistics and the how it works. Katie, if you'd like, I can get a little more into how to have that conversation, in a selling scenario, but I think this was what more directly answered the question.
Actually, Ralph, I know you typed in that question. If it's something that you would like to go over a little further, I would be happy to give you a call, or we can always get Lawrence on the phone as well. So we have a ton more questions I kind of want to address first. We can always circle back.
Sure.
But next question is going to be state approval list. Can you show that again? And what is the likelihood that you are going to be in the states in which you currently do not have an offering?
We plan to be everywhere, and we are currently in all states except New York and Montana. Okay, so the light blue states are partnership. The dark blue states, product is available, but we're not partnership there. And New York and Montana are coming. We just have to work on the filings. So we're just about everywhere.
Perfect. Another question would be regarding the employer group plans is, can the premium be payroll deducted from the employee's check?
Yeah, if the group has the ability to set that up, absolutely. We would not do that directly. We send a list bill to the group sets up deductions, just as they do for other benefits, and then they pay the list bill.
Perfect. Okay, I just had it circle back. Can you discuss bringing up the conversation? So I guess maybe
the 1035 part.
And I'm guessing that's what this is. If I'm wrong, please type in.
Gotcha. Bear with me just a minute, and I'll get back there. So here's how a lot of advisors have found success having this conversation. And it's especially good because at this point, you've already done your financial and medical pre-qualification, right? So you know about assets and income. It's especially effective when you find, say, that life insurance policy or that annuity that they really no longer need, say, because the house is paid off, the kids are grown out of college, or whatever it might be, right? And that's really how they wanted to self-insure. They're just going to use that life insurance. So you've done your financial and medical pre-qualification. At the beginning of the conversation, Mr. or Mrs. Client, I can help you in one of two ways. I can help you transfer the risk of needing care to an insurance company. Or I can help you do what you told me you wanted to do, which was self-insure. But I can help you do it better and longer than you were doing it on your own. Would you mind if we discussed both of these options? And there's a few things here that seemed very subtle, but are very important. One, you didn't say, hey, I want to talk to you about long-term care insurance. Are you interested? That's a very quick yes or no. And if they don't like the idea of long-term care insurance, they're just going to say no. What you've done here is provided options. And you told them you can help, keyword, help them do what they wanted to do. And you told them you can help them do it better and longer than they were doing it on their own. So when you get to, would you mind if I showed you both? You piqued interest, said you can help, provided options. Very rarely do folks get a no when they present it in this kind of a manner. And what you've done is you presented these options with using different words. You said, Mr. and Mrs. Client, I can help you in one of two ways. I can get you traditional long-term care insurance, or I can get you a hybrid style plan. But you didn't do that. You said, I can help you transfer the risk to an insurance company, or I can help you self-insure better and longer than you were doing it. So you see how you kind of twist the words a little bit to make this really intriguing to get to a yes. And once you get that yes, you're typically looking at a portfolio that looks something like this, right? This is a very simple version of a retirement portfolio. And they told you they wanted to self-insure using their life insurance or that annuity that they don't really need anymore. They're just going to use the cash in one of those products to do it. Let's use an example here and say it was in the life insurance. So Mr. and Mrs. Client, what I can do is take this life insurance policy, pack it into this little vehicle called a 1035 exchange, and I promised I could help you do this better and longer than you do it on your own. So when I do that, that's effectively what happens. I can take that small piece of the pie and make it much larger. once I pack this into a 1035 exchange. And that large piece of the pie could be all tax-free long-term care reimbursements. Or if you die and you never need care, it'll go right back to that original slice of the pie, right where you were. Or even if you decide in 5 years that you don't want it anymore, well, we can give you 80% of your money back at that point. When you present it this way, you almost get a, this seems too good to be true, how come nobody has shown this to me yet type of a response. And the next question is, well, how do you make a policy like this? What do the benefits look like? This seems great. Well, for the folks on this call, it's all the stuff we already talked about. If you live and you need care, I can design a policy with lifetime benefits or a 2 through 6 year benefit period with a shared benefit. If you die and you don't need care, I've got 2 return of premium options for you. Or if you decide you might cancel the policy, I can put a surrender value on it as well. So it's all the stuff we already talked about, just having the conversation being initiated by the potential for a 1035 exchange. So that was a very long answer to a very simple question of how do you have the 1035 conversation, but that is a way where I've seen a lot of folks have success with it.
Perfect. The next couple questions are regarding the group offering, but it's also going to apply for individual. What is the minimum daily benefit coverage allowed for an employer group, and what is the maximum?
All benefits and ranges of benefits are available. So in most states, we go as low as $50. In all states, we go as high as $300 a day. There's a couple states where the minimum's a little higher than the 50. I think Wisconsin, for example, might be 60. And there's a couple others. But we do not restrict any benefit offering for the employer group rate class. All benefits are available. And the reason for that, again, is because we didn't get involved with an underwriting concession. So we were able to keep this thing easy and keep everything available to you.
Perfect. Another one is, can the group option be payroll deducted? And secondly, is it tax deductible for the employee or the employer?
Payroll deduction, yes. Again, we will send out a list bill. If the group wants to do payroll deductions, it's entirely up to them how they want to handle it. We just expect a payment back for the list bill. As for tax, you're getting into a lot of specifics there. I'm sure Katie can follow up and send you our tax summary, but I will try and nutshell these for you. Your holy grail is the C Corp. If you have a C Corp paying the premium, regardless of who it's for, owner, owner spouse, employee, employee spouse, it is fully deductible to the C Corp as long as the IRS deems it as reasonable compensation. And it is not seen as income to the recipient. Okay, so C Corps are your holy grail. As for pass-through entities, so, S Corps, partnerships, sole proprietors, etc. With those, if the business buys it on an employee or an employee's spouse, it is deductible by the business, not seen as income to the employee or said spouse. If the business buys it on an owner or an owner's spouse, the business deducts it, then it is seen as income to the owner or the owner's spouse. Then the owner and or owner spouse can deduct some of it, or maybe all of it, up to the age-based amounts the IRS refers to as eligible long-term care premiums as part of their self-employed health insurance deduction. So yes, the short answer would have been, yes, there are some tax advantages available. And I know Katie and the folks at Premier will work with you on what applies appropriately to that particular business entity. And I have to end this with, of course, I'm not a tax professional, nor do I pretend to be one. So please consult a tax advisor.
Perfect. Let me just do one last check, but I think we've handled it all. Again, everyone, thank you so much. I'm sure there's additional questions. I know I've sent a couple messages out. I will reach out to a couple of you directly. If you do need to get a hold of us, please feel free to give us a call here at Premier. We're happy to help. If we can't answer it, we've always got Lawrence on speed dial to help us out in certain situations. And Lawrence, thank you so much. I appreciate it. It was great. And we look forward to the next one.
Thank you, Katie, and thanks everyone for taking the time. I really appreciate it.
All right. Have a great day, everyone. Goodbye.